Thank you, Mike. Let's stay on the markets. Our next guest says the economy is experiencing a no-landing scenario with continued growth challenges for the expectations of rate cuts. Joining us now is Bianco Research President Jim Bianco. We are seeing some signs of a slowdown, though, Jim, aren't we? We got it in the manufacturing data for February. Job growth has been strong, but we're expecting 200,000, which is still strong this week, but shows a little bit of cooling. You don't see it?
The manufacturing data has been weak for 2 years. And for the last 2 years, actually for the last 6 quarters to be more exact, we've had the GDP growth at either trend, which is 2.5 or higher. And we're expecting that in the first quarter. That is the consensus on the street. And there's really no sign, as you pointed out, with the labor market slowing down. There was never a recession in the cards. There was actually never a soft landing in the cards. I think it was more wishful thinking by a bunch of people on Wall Street that just want the Fed to cut rates. And so that the economy continues to move along. And I think inflation is showing serious signs of bottoming at 3%, not at 2%. This is going to put the whole narrative that the Fed is going to cut rates later this year in the doubt. What I've actually argued is that the narrative for the Fed cutting rates will perpetually be they will cut rates in 60 to 90 days. And then in 60 to 90 days, they'll say they'll cut rates in 60 to 90 days. And we'll just keep playing that game into the future.
So you think they're just going to kick this can down the road and there are no rate cuts this year?
Only because the data is not there. The Fed is data dependent. They want unmistakably weak data. By the way, you want to know what unmistakably weak data is? Stock market goes down on it. The stock market doesn't see a bad number like it saw on Friday and then rally because the Fed's going to cut rates. That's not unmistakably weak data. So if we see unmistakably weak data, then a rate cut is back on the table. We're not getting that right now. What we're getting is gamesmanship, that we see data that's weak and say, oh, Jay's going to cut rates for us, so let's rally stocks. And that's not going to get the job done.
But Jim, what explains the recent price action in the face of expectations for cuts getting peeled almost in half?
Because they're coming, and don't get yourself too bogged down with when they start, whether it's March, May, June, July, that the market or the stock market believes there are Fed rates coming. There is easy money coming. The Fed will cut QT, quantitative tightening, and provide more liquidity to the system. That is the belief on Wall Street, and that is predicated in a lot of markets. If we get that, I understand why the markets are doing that. But what I see in the data is a data-dependent Fed is going to meet around the table and go, this data does not warrant rate cuts. And that's going to become more frustrating as we move forward through the rest of the year.
Big piece in the Journal today. The world is in for another China shock. They basically argue that China is going to export not just deflation, but that their buying activity is nowhere near where it was in the last cycle, and that it's going to push inflation down even more. How do you handle that?
Yeah, I mean, that is a narrative that's been around for a while. The Chinese economy is very weak. They're not buying stuff. That their production is going to kick up, and they're going to start producing stuff and sending it to the rest of the world at ever cheaper prices. That is not a new narrative in the marketplace right now. But I don't think that that's the narrative that is really driving the inflation story. What that is implying is we're going to have further goods deflation. But the problem with inflation right now is services and housing. China has nothing to do with services and housing. They only do goods. And if services and housing stay the problems, then that inflation rate is not going to come down to give the Fed the room that they need in order to cut.
You make a compelling case, Jim, but here's the thing. The Fed is not there. So maybe you just think they're not there yet. But if you listen to all the Fed speak, while they're making it clear they're not in a hurry to cut rates, they mostly suggest that they are in restrictive territory when it comes to rates. In other words, that we are at historically high levels that will ultimately and are restraining the economy in pockets like, okay, manufacturing, real estate, cost of capital for companies is much higher, and that eventually they're going to have to lower rates to get them back to more normal levels.
This is the real question around the Fed table is, are they in restrictive territory? And you're right. They say that they are in restrictive territory. They say that the funds rate at 2.5% is neutral. At 5.5%, it's 300 basis points too tight. But the reality is it's getting very hard to find data that suggests it's been restrictive. And there are some quarters within the Fed that are starting to bring up the idea maybe the long-term inflation rate's 3%, and it's not 2%. And maybe our start, how much above the inflation rate, is not 50 basis points, but it's more like 100. In other words, what I'm trying to say is Maybe the neutral funds rate is 4 to 4.5. We're still restrictive, but not nearly as restrictive as we thought, which is why the economy can handle this level of interest rates and why it is not slowing things down and maybe bringing inflation from 3 to 2 like everybody's hoping.
How about finally, Jim, the long-term bull narrative that productivity is going to adjust what we think is a restrictive real rate? And if you do believe it, how far away is that day?
No, I do think that productivity is going to pick up, but here's the problem. Every financial crisis, every recession, the economy changes when it comes out of it. This one changed as well, too. Changed does not mean worse. Changed means different. We are spending at a higher level than we've seen before. Propensity to spend is much higher. Remote work is probably the biggest game changer. We don't want to admit that it is having a tectonic shift in the way that the economy works. When the economy changes like that, how do you become more productive when you're not even sure where it's supposed to be in the first place? First, we have to stop talking about rebalancing the economy, normalizing the economy, going back to a pre-pandemic level, which is what Jay Powell says all the time. That's over. That era is over. We're in a new era, and new does not mean worse. Tell me what that new era is. Then we could go about using technology to be more productive.
So is this all one big way of saying, Jim, that you're bearish on bonds?
Yes, it is a way of saying I'm bearish on bonds because I don't think that bond yields have been punishing. I don't think that the Fed is going to be raising rates cutting rates nearly as much as everybody thinks. I think the path for least resistance on bond market is going to be higher, and that is something that the stock market has to contend with. It's going to have competition with a 5 to 5.5% money market rate, probably for the balance of the year.
All right, Jim, thank you. Appreciate you joining us. Jim Bianco Research. No landing back on the table.
Still to come this morning, the